Welcome to Financially Speaking, brought to you by Buska Retirement Solutions and its affiliate firms. We offer retirement, tax, and legacy planning from a dedicated family-built team. In today's episode, we're discussing a major shift in financial planning, the difference between accumulating wealth and distributing it in retirement. Later, we'll tackle a popular online question. Can you retire as early as 30 with $1 million? And now for our weekly question and answer segment.
Welcome back to Financially Speaking. Today we're discussing a major shift in financial planning, the difference between accumulating wealth and distributing it in retirement. And I'm here with Cole and Zach. We're about to kick this off. So let's get into what is the biggest mind shift between accumulation and decumulation, building the pile and spending the pile.
Sure. The biggest shift, is going from trying to maximize your growth through your working years. So obviously as you're working, you're not so much worried about how much dividends are coming in. You're worried more about what is the compounding on my account for the growth. Yeah. Where when you enter retirement, yes, you still need a portion of your portfolio with that growth mindset, but it's more about how do I create my cash flow to meet my monthly obligations.
Yeah, you want to make sure that you're setting yourself up for income versus just simply growth. I know a lot of clients think all they need to do as they get closer to retirement is just get more conservative, right? Maybe put more money into bonds or whatever it might be. But it's really creating a distribution strategy and then utilizing distribution-focused investments for those types of vehicles in your portfolio. And so there is a fundamental shift that occurs when we migrate from accumulation to our preservation and distribution years.
It also seems like you have to pay more attention during decumulation. When you're working years, you've got the paycheck coming in, you've got cash flow, so it's kind of set it and forget it for most people's 401ks, isn't it? But how does that change then going into decumulation? What other things do I need to be thinking about?
Well, I think one of the things that we see very often is some people think, maybe I'll just leave my money in my 401k plan, when I retire.
It's been doing good so far.
Sure. Yeah, absolutely. And that's something that we hear often, especially lately, because the market's done well over the last several years, right? And so one of the things that we educate clients on is 401ks are very limited in terms of the scope of the type of investments that you can make within them. You have your lineup of maybe 10 to 20 different mutual funds that you can select from.
Retirement date funds.
Yep, very common, absolutely. And basically with a 401k, it's really more designed as an accumulation tool. You're putting money into these various different mutual funds, pumping contributions in there, company matching funds, all of that kind of stuff. And when you get to retirement, oftentimes a rollover can make a lot of sense because it's going to give you more flexibility in terms of what you can do in terms of investment, and it allows you a much more creative allocation strategy. Then you can pick from thousands of investment options versus just a handful.
Your menu changes a bit.
Exactly.
Sure.
Absolutely. Mm-hmm.
Okay. And what types of risks do I have coming into decumulation that I didn't have in accumulation?
The biggest risk I would say is sequence of returns, because once you start pulling money out, you obviously don't want to be pulling out heavily in a big negative year.
Right.
So if your first couple years of retirement, if you see a big downturn, that's going to hinder how long your money's going to last over the long period of time.
Yeah, and that's part of the reason why we use our color of money system. So green money safe, yellow money is going to be more at risk but managed. Red money would be at risk and unmanaged. And so having an adequate amount of money in green investments when we start taking distributions from our strategy is going to give us more control because it allows us to then be strategic with what side of the portfolio we're actually drawing from depending on market conditions. So we educate our clients, we draw from our yellow money, our managed portfolio, when the market's performing favorably. And when the market inevitably has a downturn at some point in the future, we simply stop taking distributions or dramatically reduce the distributions from that managed portion of the portfolio and move that over to their green money, their safe money. So that way they're drawing from something that's not losing money per se. Maybe it's not earning a whole lot at that point in time, but it's not losing anything. So therefore we're not locking in losses, which is effectively what creates the sequence of returns risk.
Yes, because you guys have caught me with the one before of if I have $1, lose 50%, I got 50 cents. What percentage gain do I need to get back? I said 50%, you said no, it's 100.
Right.
Losing's not the same as gaining because you're gaining on a smaller amount of money.
Yep.
So effectively what you're saying is taking money out and losing money is making the account go backwards faster, and that's
Yeah,
bad.
yeah, it's inevitably going to shorten the lifespan of how long that money is going to last.
And do you then try to set up the same experience I had at my job where you got a cash flow bucket and a investing bucket? Because I would assume that more people are concerned about their cash flow than they're investing really at the end of the day in retirement, or are they really more concerned about investing?
I think it's kind of both, really.
Okay.
I mean, I sorry, cut you off.
That's okay.
I always tell my clients I kind of set up their investment strategy in kind of 3 buckets. I mean, it's something we're taught in college and finance classes is you have your 3 buckets, your shorter term period immediate needs that need to be met.
Yeah.
You got your midterm that kind of feeds the short term obligations, and then your longer term bucket is what's kind of growing that'll eventually move down into the shorter term bucket.
Yep. Yeah, it's all about being prepared for whatever may come because, the market is unpredictable and we can't control when the market goes up or down. All we can control is how much exposure we have to it and what impact it has on our ability to generate income in retirement. And obviously, anything that's going to potentially shorten the longevity of how long your money will last is something that we should definitely proactively plan to prevent.
I think most people maybe aren't worried about hitting zero, but having to change your lifestyle because you can't afford it is generally not something people are interested in, right? Lifestyle must drive a huge component to this, doesn't it?
Yeah, absolutely.
Yep.
So what other things are you looking at when you're getting into decumulation? You mentioned taxes, investing. What the investment risk, can't I just remove the investment risk by putting it all in super safe instruments?
I mean, you can.
Is there the risk to that?
Yeah, for sure. I mean, you're looking at inflation risk for sure. I mean, that would be the first and foremost. I mean, inflation is running at a little over 3% right now based on current
Feels like
calculations. Feels like more than that. We've got high gas prices, and obviously that will, potentially impact inflation as well. But at the end of the day, just putting all of your money into like a CD or something completely safe, it might sound attractive because then we don't have to worry about the market risk. But I mean, the long-term average return on a CD once we're out of this higher interest rate time frame is probably going to be 2 to 3% per year,
And it's still taxable.
Exactly,
Yeah.
exactly. And so, I mean, we definitely should have some safety in our portfolio, like we were saying before, but we also still want to have some of that money that's going to be exposed to some sort of risk. We believe actively managed risk, obviously, so you've got a team of professionals overseeing that for you.
Right.
But you want to have some exposure to that long-term growth to help combat and stay ahead of inflation.
Very good. So do you start then, if you're with a retirement plan, choosing investments, or do you start by determining the decumulation or the income portion? Where do we start?
A lot of the income portion, because obviously that's going to determine how we want to allocate your assets. I mean, not only the income portion, you got to understand who you're working with, what are their risk levels, what are they comfortable with.
Sure.
But it's looking at the big picture, do they have, what's their Social Security going to be? Do they have a pension? Do both spouses have a pension if it's a couple? And then what are their monthly obligations? And then kind of based on that, working backwards to say, okay, do you have an income gap? Do you not have an income gap? And that kind of leads us down the path of determining the starting point for the conversation on how to invest.
Yep, absolutely.
All right, that makes perfect sense. Let's take a quick break here, but you guys hang around. We'll get back into it. And after that break, we'll discuss how to turn savings into sustainable income, so stay tuned.
Do you have a plan for how your assets will be handled after you're gone? Without one, the state could step in and make those decisions for you and your family. Through our partnership with Estate Guru, we make the estate planning process simple and affordable, offering wills, powers of attorney, and revocable trusts. On average, our services cost 70% less than traditional estate attorney fees. Contact our office today to get started.
During times of career change or uncertainty, it may be a good time to take a closer look at your retirement accounts, especially if you're nearing age 59 and a half. A 401k rollover could help simplify your finances and give you more control, from your investment options and costs to how and when you access your money. It can also be an opportunity to work one-on-one with a financial professional who focuses on your goals, not a one-size-fits-all company plan. So call our office today to schedule a complimentary consultation and see if a rollover makes sense for you.
And now back to our weekly question and answer segment.
Before the break, we talked about how retirement planning changes once you stop earning a paycheck. Let's get a little deeper into that. We talked about accumulation, decumulation. How do Roth conversion accounts, we talked about investing, but taxes play into this. How do those affect tax efficiency, especially for beneficiaries?
So, I mean, the tax efficiency for beneficiaries is coming from a Roth is once they're inherited, it's all tax-free income to them.
Yep.
So, I mean, that's the biggest benefits to the beneficiaries, especially, say, in the relationship between the person inheriting the account and most likely coming from a parent, is the parent might be in a lower tax bracket compared to what the child is during their working years when they're most likely going to be inheriting the account.
Right, exactly. I actually just had a conversation about this with a client recently. They came in for an initial consultation and they had just inherited some money and they're at the highest level of income that they've ever been in their career. And now they're forced to liquidate that larger IRA, which is taxable, over the course of the next 10 years. And so he still plans to work for 5 more years. And he's like, so now I'm going to be in a much higher tax bracket for the next 10 years because I have to take this money out. I don't have a choice, right? And so for people that are thinking about Roth conversions, especially those who plan to potentially leave a legacy for their loved ones, obviously leaving a Roth legacy is going to be much more valuable and they're going to retain more of it than if we left it in a taxable legacy, because obviously they're going to be at the mercy of whatever their tax rate is. And like Zach said, I mean, if their parents are in a lower tax bracket than they are, then it makes sense for them to be considering those Roth conversions and moving those funds over at those lower tax rates to prevent their kids and the government from having to, from them having to pay a much larger percentage into the government and therefore retaining less of your legacy.
And one thing we talked about at the break too that I didn't know was that you said some people don't like the idea of Roth conversions because they think that it's going to reduce the account balance going down. So $1 million IRA, let's just say, because I'm not that great at math, so I'll use a nice round number, $1 million becomes $600,000 when I pass it through. But you mentioned you don't actually have to pay the taxes from that account. Is that true?
That is true. Yeah, absolutely.
How does that work?
Well, think about it this way. Let's say you're converting $50,000 and you're in a 12% tax bracket. So your tax liability is going to be somewhere in the $6,000, $7,000 ballpark, right? For federal income taxes anyways. So if you decide to convert that $50,000 over, you have 2 choices. Either one, you move the $50,000, withdraw the tax from it and send it into the government and drop the net into that particular Roth. Or you put the full $50,000 into the Roth, and let's say you've got $100,000 just sitting in a low interest-bearing savings or checking account. Well, you can take those funds and then use that to pay the tax on the conversion instead of reducing the converted amount.
Which makes total sense because the government doesn't care where the $7,000 comes from.
Nope.
Just send it over here.
Yep, exactly. As long as they get it, that's all they care about.
It's funny the things people think. You just think a certain way. Of things must work this way until you find out they don't. You're like, oh, that makes total sense. I should have thought about that.
Right.
How do trusts play? Because and here's where I guess we're going with beneficiaries too. Is you mentioned the people, you don't want to run out of money. You always hear that, but realistically, running out of money to most people is changing their lifestyle because they couldn't afford it. So you're going to most likely pass away with something. $200,000, $400,000, $600,000, which you might say, it's only $200,000 I'm leaving behind. Only $200,000. To a family with kids is a big only.
Oh, for sure.
How do trusts play a part in passing that tax efficient money through?
So, I mean, the trust is a legal structure where the trustees or the grantors who set up the trust dictate how they want the assets spread out after their passing. A lot of times, trust-owned accounts would be non-qualified money, which is going to be your after-tax dollars, like a savings account, something that might have been an individual or a joint account that you converted to a trust account. And then the taxes on that, non-qualified accounts, you get step-up cost basis at the time of death. But then those, rather than flowing directly to the beneficiaries, would flow through your trust, dependent on how you set it up and how you want things distributed.
And it also depends on the type of trust, because there's a variety of different types of trusts, and obviously there could be different tax implications with each. Typically, we don't see a ton of people with like revocable trusts and things like that, leaving their IRAs to the trust, because a general concept of what the trust is designed for is helping avoid probate, right?
Yep.
At least basic trusts.
And what is probate? We hear that word a lot. What is it? How does it work?
So probate is essentially a process that your loved ones, your family, your beneficiaries will go through in the event that you don't have a trust and you have assets that don't specifically have a beneficiary designation.
Yep.
One common one that triggers probate very often is your home. Let's say you pass away.
There's no beneficiary in your home.
Unless you file one,
Right.
which you can. You can do a transfer on death deed on a real estate property. And then if that's filed with the clerk of courts, that's going to bypass probate. But let's say you have in Wisconsin, the limit for probate is $50,000. So, I mean, if you have a vehicle nowadays, you're probably going to have to go through probate. So one of the advantages of the trust is you can then own all of these different assets within the trust, and therefore it then bypasses probate because it assigns a beneficiary designation to all of those types of assets.
Sure.
Your IRAs, your 401ks, those types of things, you usually have a beneficiary designation on them.
Assuming you put one in.
Correct.
Yeah.
Yes. So always something you
And
should check
assuming you have
on.
the right one in there.
Well, this is true too. And so lifestyle changes, all that, make sure you're checking your beneficiaries regularly, obviously. But if you have a beneficiary designated, it's going to be transfer on death. So it's not going to go through probate. It's going to go directly to those beneficiaries as long as we have one listed.
Okay, good. And how does life insurance, and we've talked about life insurance before, people say, oh man, I had life insurance, I don't need it when I'm retired, or
Sure.
you hear things like that. How is that used as a wealth transfer tool?
I mean, it's played a couple different ways. Two of the most common ways is one, a tax-free inheritance to the beneficiary. And some ways that I've worked with it in the past is somebody has a large IRA balance, and because of taxable reasons where their income levels are, we're not really talking about Roth conversions, but they have enough free cash flow where we can get a life insurance policy that will help pay the tax liability to the person inheriting the pre-tax dollars.
Yeah. So, I mean, let's say, for example, you have $1 million IRA, and we assume the tax liability to the beneficiary on that account is going to be somewhere in the ballpark of, let's say, $200,000 or $300,000, right? Well, then, if we wanted to make sure that they retain that full $1 million, you could take a life insurance policy out, like Zach mentioned, and buy a life insurance for $200,000 or $300,000, and then it pays the tax liability for them, so they don't have to worry about being responsible for pulling that out of the $1 million IRA balance.
Got it. How often does a legacy plan like that need to be reviewed?
Well, I mean, we would recommend regularly, obviously. Sure. I mean, when we meet with our clients, we're regularly not only reviewing their financial plan, but also their, legacy plan, making sure that their needs haven't changed, their wishes haven't changed. Because, I mean, families are dynamic. Sometimes things adjust. Sometimes new grandkids come into the picture, and we want to make sure they're included in the inheritance or whatever it might be. So I would say regularly doing that is definitely a good thing. Once a year is probably a good way to approach it.
Great. Well, thanks for joining us today. And for those of you that don't have an income plan, you go from your working years of getting a paycheck and building the pile of money to the paycheck shutting off and living off the pile. Can you do it yourself? Possibly.
For sure.
However, if you do it and use a financial advisor, someone who can understand the rules, maybe you can perhaps maximize the income you get in retirement, maximize your lifestyle, and leave more to your heirs. Again, if it doesn't affect your retirement, why not leave them a bigger pile than a smaller pile, huh?
Yeah, absolutely.
Thanks for joining us, gentlemen, and thanks for watching.
At Buska, our goal is to streamline the retirement planning process to help you move towards a successful retirement with confidence and ease. Through our 3 companies, we provide a comprehensive approach to planning your future. We work closely with you to create a personalized, comprehensive retirement plan that reflects your unique goals and financial situation. Our team integrates investment management, income planning, tax strategies, estate planning, health insurance, and Medicare planning all under one roof. That means fewer appointments, less stress, and more clarity as you prepare for life's next chapter. Whether you're just starting to think about retirement or looking for a second opinion on your current plan, we're here to help you feel more confident about your financial future. Call us today at 715-355-4445 or visit retirewithbuska.com to schedule your complimentary, no-obligation consultation. Let's make retirement planning easier together.
And now our Financially Speaking Weekly Desk segment.
Welcome back to Financially Speaking. I'm Sue Buska, CEO and founder of Buska Retirement Solutions and Buska Wealth Management, joined by one of our private wealth advisors is Ryan Pekka. So today we're going to be tackling a question that gets a lot of attention online. Can you retire early, even as early as your late 30s with $1 million saved?
It's a fascinating idea, Sue. There's a growing movement around early retirement, but an article from Investopedia called Could Retiring at 39 with $1 million Really Last Your Lifetime makes it clear that it's not as simple as hitting a number and walking away.
Well, exactly, and retiring at 39 means your savings may need to last 50 years or more, and that's very different from a traditional retirement that might last 20 or 30 years.
And that longer timeline introduces more risks. You're not just dealing with market ups and downs, you're potentially facing decades of inflation and rising healthcare costs.
That's right, Ryan, and don't forget home repairs and other surprise costs. So the big question isn't just, do you have $1 million? It's how are you going to use it?
That's where something called your withdrawal rate comes into play.
Okay, so your withdrawal rate is simply how much you take out of your savings each year, and small differences here can have a huge impact over time.
For example, withdrawing around 3% per year, which is about $30,000 on a $1 million portfolio, has historically given people a much better chance of making that money last for several decades.
But once you start increasing that number, the risk goes up. At 4% or $40,000 a year, it becomes much more sensitive to market performance.
Yeah, and at 5% or $50,000 a year, you're really pushing it. That level leaves very little room for error, especially if the market struggles early on in your retirement.
And that brings up another important concept. It's something we like to call sequence of returns risk.
Yeah, that's a big one. It refers to what happens if the market drops early in your retirement while you're also taking withdrawals.
Because if you're forced to sell investments during a downturn, you're locking in those losses, and over time, that can be very difficult to recover from.
Absolutely. One strategy some people use to manage that risk is to keep 1 to 2 years worth of expenses in cash.
And that makes sense, and that way if the market dips, you can rely on the cash instead of selling investments at a loss. And it gives your portfolio more time to try and recover.
That's right. Now let's talk about how that money is invested, because that can matter just as much as how much you withdraw.
And a lot of people assume that once they retire, they should move everything into very conservative investments like cash or bonds.
Yeah, but over a 50-year retirement, then it can actually be a risky in a different way.
Well, exactly, Ryan. And conservative investments may feel safer in the short term, but they don't often keep up with inflation over long periods of time.
That's right, which means your purchasing power can slowly erode over that time.
Well, on the other hand, a more growth-oriented portfolio that includes a higher percentage of stocks has historically offered better long-term growth. But past performance is not a guarantee of future results, right?
Of course. That comes with more ups and downs, which can be tough emotionally, especially during market volatility.
So it becomes a balance between growth and stability, and that balance may need to change over time.
That's correct. Another factor people sometimes underestimate is spending.
Well, that's a great point, and it might be the biggest piece of the puzzle, because even small increases in spending can have a major impact over decades.
For example, spending just $5,000 more per year might not sound like much, but over time that can add up to hundreds of thousands of dollars.
And that's money your portfolio no longer has the chance to grow.
That's why flexibility is so important early in retirement.
Right, and being able to adjust your spending, especially during market downturns, can significantly improve your chances of long-term success.
Yeah, some people also build in other sources of income, like part-time work or side income.
Well, even a modest amount of income can reduce the pressure on your portfolio and help extend how long your savings will last.
Yeah, we should also talk about two major expenses that can really impact early retirees: inflation and healthcare.
Well, inflation may not seem like a big deal year to year, but over time it adds up, and around 3% inflation, your cost of living could double in about 20 to 25 years.
And healthcare is another big one, especially before Medicare eligibility at age 65.
Monthly premiums alone can range from several hundred to over $1,000 depending on your situation.
So when could 1 million actually be enough?
Well, in general, it tends to work better for people who keep their expenses relatively low, avoid high fixed costs, and are willing to adjust their lifestyle when needed.
Living in a lower cost area like many parts of Wisconsin compared to larger metro areas can also make a meaningful difference.
Well, and on the flip side, higher spending, expensive housing, and more lifestyle-driven retirement can put a lot of strain on that same $1 million.
Especially if there's little flexibility to cut back during tough market periods.
Yeah, and the bottom line is that $1 million isn't a magic number. Whether it works depending on your spending, your investment strategy, and your ability to adapt over time.
And if early retirement is something you're considering, it's worth having a plan in place that accounts for all of those moving pieces.
That's right, and that's where working with a financial services professional can really help, especially when you're trying to make your savings last for a multitude of decades.
Well said.
Well, we're out of time for this segment, and if you have any questions about your retirement strategy or want help building a plan that fits your goals, visit or call. We'll be right back with more after this.
Are you confident in your retirement plan or just hoping it works out? Do you hear from your advisor regularly? Do you understand your fees? And do you know how taxes will impact your income? Now, if you hesitated on any of those, you're not alone. At Buska Retirement Solutions, we offer a complimentary second opinion, so you can move forward with greater clarity, not uncertainty. You deserve clarity, you deserve confidence, and you deserve better. Schedule your complimentary retirement review today. With recent market changes, it's understandable that some people are feeling a little anxious about their financial future. That's why now might be a perfect time to review your financial plan. A financial services professional is trained to help you stay focused on the facts, not emotions, when it comes to your strategy. Getting a second opinion today works to ensure your investments are properly positioned to weather market volatility and that you're not taking on more risk than you realize. Let's work to make sure your plan is ready for whatever comes next. Call us today to schedule a complimentary review with one of our financial professionals.
Thank you for tuning in to this week's edition of Financially Speaking. We're glad you were able to join us today, and we hope you learned some useful retirement tips along the way.
On today's show, we covered a number of important topics, and hopefully we did so in a manner that was easy for you to understand. This is the same way we communicate to our clients when we meet with them in person. Remember, with the help of the right financial services professional, you can create a quality retirement, and our team is here to help. Right now may be a great time to get a second opinion on your retirement plan. Give us a call at 715-355-4445 or go to retirewithbuska.com to continue your retirement education, catch up on previous episodes of our TV and radio show, or schedule your complimentary, no obligation consultation.
If you have any questions or comments about today's show, call us at 715-355-4445 or feel free to send us an email at info@retirewithbuska.com. Join us next week at the same time and same place for another episode of Financially Speaking.